If you have that system to maintain, uplift, and process things and let the teams focus on the true value add components of close, I think that's critical. I think automation is not just efficiency, but I think it's also accuracy under pressure, which again is just key for a public company cycle.
From Numeric, this is Incoming Statements, the podcast built for forward-thinking accounting pros. Join Anthony Alvarez, Numeric's co-founder and chief product officer, as he talks with accounting leaders about what practices and philosophies are defining modern financial operations. So grab your coffee, throw on some headphones, and let's dive in.
Hello and welcome to another episode of Incoming Statements. I'm your host, Anthony Alvarez, and this episode is brought to you by Numeric, AI-powered close and reporting automation for leading accounting teams. Today, our guests are Joanna Lynch, partner in technical accounting, and Jordan Teitelbaum, partner in financial operations, both of whom work at Connor Group. Jordan, Joe, thanks so much for joining me today.
Absolutely. Happy to be here.
Awesome to be here.
Excellent. Well, Jordan, Joe, thank you so much for joining us today. I'd love to ask, really to start things off here, how would you say the world of accounting found you? If there's any origin story that comes to mind that you'd like to share with the group, would love to hear it.
Yeah, awesome to be on. I do remember, way back in the day, my grandfather was an accountant, and that was something that I was followed in those footsteps. So that was always interesting. And I think throughout my adult life, I've had sort of an interest in psychology, right? And that would be my second career if I could pick one. And I think that dovetailed nicely to, listening and observing to our clients' challenges. And I think it's kind of a perfect mix there, but
awesome.
All stems back to the grandparents. That's all.
Awesome. Well, I think there might be a follow-up podcast on the psychology of accounting, of which I'm sure we could get into quite a bit. But cool, that's great. Joe, how about yourself?
Well, I'm laughing at that is because I actually majored in sociology in college and, did all that, the communication stuff. And towards the end, I took a class on accounting and really liked it. And ended up switching to accounting and staying with accounting. But what I always say, and frankly, especially when it comes to IPOs, is one of our main roles when it comes to working with clients in an IPO situation is listening and really kind of problem solving from all aspects, the accounting for sure, but also just the being a psychologist and therapist and helping people through that process and all of the angst and all of the fun stuff and all that. But, being a therapist is actually pretty high up there on what we do. So pretty funny that you said that, Jordan.
Mm-hmm.
Awesome. Well, I'll be excited to talk more about that today, given we are talking all things IPO readiness, and surely one of the most anxious possible experiences for folks in finance and accounting to undergo through their career. We're going to spend some time today talking about, how companies approach the journey and in many ways the lead up to that journey and how they can best prepare themselves for deciding when the time is right, deciding how to operate on the ground when it's happening. I feel like we often hear whispers of companies considering an IPO, in some cases, years before the listing itself. Obviously, windows of opportunity in the market aside, I'd love to start with a bit of a level set on what it looks and feels like on the ground when a company starts to become eligible for the public markets. For our audience, would love to just get kind of a baseline understanding of, from your perspective, from your observations, how companies know it's coming, how they can prepare. Obviously, it'll be more of what we get into, but if we could just start there, what does it feel like?
I really see two different things. One, from the broader standpoint of, is a company ready from a business standpoint, from an industry standpoint, and all that stuff? If it's a biotech, is there development at that stage, right? And that, frankly, is really at the board level. They're talking with bankers. There's all this stuff. And are you ready from that standpoint? Can you sell your story, right? Do investors want your story? And then the other side is the side that we're probably a little bit more involved with, which is the infrastructure, is the accounting, is the finance folks ready to be a public company, right? And what we really want to see is that you lead with the former and the latter is not what is the long pole, right? You want to be ready for whenever the business is ready to go. And again, so those are kind of like the two sides that I see, very interrelated, obviously. And we're really focused on that second side as part of the finance team. Jordan, do you have any thoughts there?
That's exactly right. I think, one of the things we stress to our clients is there is always going to be that market window, obviously. And, we don't so much have to do with that management consulting piece of running the business, driving results. Of course, management needs to be doing that, but we need to, behind the scenes, be investing in that infrastructure such that when the business is ready and when the market is ready, we're not the long pole. The accounting folks, the operation folks, the legal, the governance folks are not the long pole. So that is, key to everything that we do. Planning early, planning ahead, being ready. We never want the accounting and finance folks to be the holdup, and we want to make sure we're supportive of the direction the business wants to go.
Certainly. Let's talk about some of that infrastructure then. Where do you see some of the longer tails most commonly, or maybe it varies by industry, et cetera. But when you think about that core infrastructure, getting it right, getting the team right, getting the tools in place, what are some common pitfalls? What are areas folks could have gotten in front of sooner that maybe they're not thinking about? In some ways, would love to just jump into what's the approach when you think about some of that infrastructure?
Yeah, we usually break it down into a couple different areas from a readiness perspective. One of them is a little bit less infrastructure, but very critical and often overlooked. That's on the historical accounting side. We'll dive a lot into that, I'm sure, especially where Joe focuses. That's things from financials to PCAOB uplifts to disclosures and quarterlies and SAS 100s and all that great stuff. Then there's a lot on, great, we've got the historicals and the technical piece. What about from an ongoing perspective, a current accounting perspective? Are we able to close the books? Are we able to do so timely? Are we able to do so accurately? Do we have changes in the business, and are we able to react to those appropriately? And then ultimately, financial reporting. Can we report out to the public with all that same framework, with the accuracy, with the timeliness? One of the other big buckets outside of sort of core accounting is you think about, are your people, your processes, and your systems able to support everything else that was just mentioned? And then we'll go into, are we actually able to produce that S1 document? So those are the sort of pillars that we think about and how we break it down. A lot goes into each of those, but those are the sort of streams that we think about. Joe, anything to add?
And it's interesting because, as we're looking at it from a timeline perspective, you've got the historical audits, you've got the S1 document itself, and then the ongoing reporting, which, for a lot of folks, there's this huge focus on the IPO event itself, right? And we always say, okay, well, that's great. And there's a lot of work. And frankly, in a lot of ways, that work is easier to be outsourced because it's a little bit more discreet. Not all of it, obviously, but easier to kind of make that big push and get there. It's the ongoing infrastructure needed for that. You're a public company now. Great. Now the fun begins, and now a lot of work begins. And are you ready for that piece? And so it really, you really do need to focus on all three. They have very different, or sometimes concurrent, but definitely different timelines and focuses. But, you can't do one without the other.
Mm-hmm. Yep. So people, process, systems being the three. Is there one area where you see most commonly folks are lagging behind? Is it truly entirely variable by business in terms of what they've just happened to invest in earlier on? Where do you see that most common issue or most common deficiency?
That's the first thing that comes to mind is processes, right? Like, of course, there's always investment in people that can be made, but usually, we as outsiders can help prop up companies and teams really nicely. And again, there's specialties and special SMEs needed as part of the process, but it's, people is usually something that is fixable, achievable. There are leadership roles and positions just as part of the broader IPO that, of course, is going to be critical. But my initial thought is it usually comes down to process. That's usually kind of one of the bigger ones that's challenging. Systems, there's a lot of really good systems out there that can help support. But, maybe it's also partially biased here because I focus a lot on the process. So that's my thought. Joe, anything else?
Hey, when we talk about the three, I think the three work streams, it's people, process, and system. People can obviously cover all of it. The system piece is probably a little bit more from the ongoing standpoint, obviously important for historical to make sure that you trust your data, right? What we do find sometimes is when folks want, likely when you're right in the middle of that IPO is not the time to be implementing new systems and having to go live, at the same time and all that stuff. So it really kind of depends on scheduling it out and is where you are with your current system such that you can do financial reporting in a accurate enough fashion, right?
Mm-hmm. Awesome. Well, and on that vein, then when we think about one of the processes, well, really dovetails into all three, right? But that being the month-end close, I'm curious what has been, call it the average situation that you tend to walk into when a company is evaluating IPO from the close standpoint. Obviously, we know it's a challenge for many private companies, but the expectations for public companies are heightened. Regarding the close, where would you say there are some of the biggest gaps here? Where do you think folks need to be rethinking or could be rethinking certain processes, automations, controls earlier on in their sort of life cycle as a business? Any war stories or thoughts you have here would love to dig into next.
Oh, yeah, absolutely. Yeah, you said it well. Public markets will demand financials and not just financials, but audited financials. And all of this within a strict timeline. So really no room for inefficiencies and at the same time, no room for sacrificing quality. So we also know, all three of us online know that accounting is often not getting the most attention up front and limiting the potential for investment there. So close specifically, I think one of the biggest gaps that we see is the lack of scalable processes, right? So a lot of the private companies will start working with really heavily working on manual interventions, manual processes, Excel sheets, reconciliations are done ad hoc or maybe not even done at all. And controls are maybe good enough or also not existent. So again, I go back to, it all comes back to the process level. I recommend starting there before investing in systems, starting with standardizing things like your reconciliation templates, your checklists, and your closed task lists, things like that. Absolutely critical before you lean heavily on automation. Garbage in, garbage out, age-old concept. Ultimate goal there is to get to consistency and to get to produce something for your monthly close that is repeatable. Now, all that said, we thought about the process. Moving on to automation, of course, is going to be key for scalability. And again, you got perfect lead into you guys, a tool like a close management software to reduce the manual workload, to me, is a no-brainer. If you have that system to maintain, uplift, and process things, and let the teams focus on the true value add components of close, I think that's critical. I think automation is not just efficiency, but I think it's also accuracy under pressure, which again is just key for a public company cycle.
Absolutely. We have heard in the past this notion of a general trade-off between speed and accuracy, and it's always to some degree a gradient where you have to pick where you're prioritizing for any given, in any given situation. How do you think that sort of approach changes as a company approaches an IPO and then post their public listing? Do you find that you have to lean further in the accuracy over speed? Naturally you would, but is there still some room where where that trade-off is made, and what does that look like?
Yeah, really good question. I think first to start, it's not something that can happen overnight. It is something that you're going to need to have a long-term plan, again, depending on where you're starting from, and then work at it consistently and month over month. I think to your point, you need to start with accuracy first and then focus on that efficiency and speed. Again, a lot of times, depending on where folks are in the timeline, they kind of want to do both, but accuracy is absolutely non-negotiable. Again, with a ratchet up to that public company ready. And then, to your question, once you do get to that steady state where you've got that accuracy down, there is a lot of opportunity for things like efficiencies, not just from a systems perspective, but even on things like thresholds and building out your policies for, hey, what are we going to look at? And consistently what are we okay with passing on?
Mm-hmm.
You know, we recommend making sure you've got really good comfort over these things early on. And then once you feel comfortable, that's when you start applying the threshold and you can start backing off a little bit. But really powerful to say, hey, we've got a policy here. We've got a threshold for what we're going to look at and not going to look at. It's very powerful from an audit perspective to say, yes, we've intentionally passed on this because it's below our threshold. And it gets back to the efficiency point that allows for a little bit more breathing room once you get to that mature environment.
Excellent. Yeah, it makes perfect sense. Obviously, taking a closer look at materiality as a concept earlier on in a business's life cycle sounds like some of what we're getting at here. Are there other, call them lower hanging fruit, that you think teams could be looking at that they could easily implement that might put them in a better position, when the time comes?
Yeah, I would say, outside of the core operational closes we're thinking of, it's really never too early to think about your controls and SOX. And when I say this, I mean, of course, people will have a reprieve for SOX, and SOX 4.4 does not need to start on day one. But making sure you're coming into the process eyes wide open and saying, hey, what are our gaps? And yes, we'll have some time to implement and remediate them, but doing so in a really thoughtful way. And as you're building out your processes, you're doing it in a way that will be compliant with SOX when you need to get there. So really that should be at the forefront of all of the things that you're implementing, even though you will have some time to actually get to full 404. I do remind clients very often that if you're seriously looking ahead to an IPO, that it's not just SOX 404 A and B to be thinking about, that auditor and management attestation on your control environment, but that SOX 302 and 906 standard is something that will come out immediately upon your first quarterly or annual filing. So that's one that often catches companies by surprise.
Mm-hmm.
And, I think I was saying back to when we were talking about accuracy, but then I think Jordan kind of alluded to thresholds and materiality, because one thing that we do see is, for a private company, a lot of times people keep the books open forever and you do it based on actuals and they want to be right. And the idea of accuracy can really depend, because everything doesn't have to be right to the penny or to the dollar. And it's kind of pulling back and saying, well, is it accurate for purposes of the financial statements such that it is materially correct, right? And so I think Jordan and Anthony actually did cover that, did loop back around to that. But really just being careful in that accuracy does not mean, perfection, because that, we do see sometimes companies getting hung up there. And that's one reason why close takes forever, is because they want to dive down to the penny and really make sure that it's right. And kind of making sure that mindset is maybe reevaluated.
Yeah, I think we're back on the. Oh, please go ahead.
Yeah, sometimes clients and companies are very proud of that. Hey, we reconcile this down to the penny. And of course, for certain accounts that makes sense, but sometimes it's a question of pointing out, great, you reconciled this account to a penny, but you haven't touched this whole slew over here, right? So making sure
it's taking you 5 days longer because you reconciled it down to a penny and you really didn't need to.
Exactly.
So I do think we're circling on back to some of the psychological aspects of your roles and thinking about that trade-off of or really the statement, which is accuracy does not equal perfection. It seems like there would be some mental unwinding to do in a profession where accuracy is the end goal, right? In any analysis, arriving at the exact figure. So how do you approach some of that thinking? Is it a matter of just painting the broader context of, you want coverage that spans a wider surface area and it's okay to have that trade-off? Is there something else that you help folks really conceptualize to get them to understand that perfection is not the end state for everything in all cases?
I think it comes back to like a risk-based approach, maybe, right? In a timeline and a thoughtful progression of, hey, we know we're not there right now. We know where we want to be. And we know the resources that maybe were allocated from A to B. So how do we get there with, again, a risk tolerance that we're all sort of okay with? But again, I think it's being thoughtful and it's being proactive about that longer term planning, as opposed to, hey, there's so much going on, we just need to get this done. And we can help with that long term planning.
Awesome. Well, Joe, I'd like to ask to you on this front, when you think about common pitfalls during the process, any scenarios come to mind of what would cause a company to ultimately decide, now the time isn't right. Obviously, the goal of the engagement is to get successfully over the line. But have you ever encountered situations where that's actually not viable, not feasible, and you have to press pause on the process?
Well, I think I'm going to speak to that more from the finance side, right? And you don't want to be in that situation with where because of, your finances aren't in order, you can't, regardless of whether the business is ready or not, you can't go public because you can't have those financial statements done and ready in time. And that's just not where you want to be. And frankly, we've done a lot with where companies, if they come in, ideally you have a longer timeline, whether it's 6 months to a year or longer. Can you do it in 3 months? Sometimes, right? And so it's a matter of what resources you throw at it. Now, when you actually get to the point of no, it can't happen, and we have those discussions up front, it normally, there's stuff that's within your control, within the company's control. And, you've got to get all these audits done. You have to get reviews done. You have to get everyone on board. And, push comes to shove. Can everyone throw resources and get it done? Again, a lot of times you can potentially. Mm-hmm. But, there are times when you have, let's say if a company has acquisitions and you need to have separate 305 financials for a company that just doesn't even have books and records, or there's so much work that goes into the that needs to be done to audit those. And that, for whatever reason, that just hasn't been even considered. That's one case where we've seen where it's just like, okay, hold up, just know that one, if you're going to go through with this acquisition, if it's not ready yet, or if you haven't already done it, let's make sure you understand the impacts, right? If you're looking at all these transactions, does that change your timeline from a financial reporting standpoint? It may even just change your timeline because of the story. But beyond that, like, what does it do to your ability to be ready in time? So that's probably one that I've seen more because it's a little bit more outside of the company's control as to whether those financials can be ready. Other potential pitfalls from a timeline perspective, one we see a lot is about, if something needs to be valued and that isn't assessed until, way too late in the game, with where it's like, okay, yeah, but now you have to go through that valuation, and how much time does that take? And again, sometimes you can condense it, but at some point you condense it, and there's no more time left to condense, right? Mm-hmm.
Yep.
So.
Yeah, on that front, is that more a pitfall of just a late identification of a valuation need for the business itself, things like 409A valuations, or is that more around things like goodwill impairment tests or stock comp valuations? Where do you find that primarily focused?
Embedded derivatives, strange contracts, anything that needs to be fair valued that perhaps wasn't. Again, a lot of these things, when we start, we'll say, okay, what do you have? What kind of stuff? Here's your potential risks. Let's get your, management, your auditors on board. And how do you assess? How do you even look at that? Is that an issue? Right. So it's really just identifying as early as possible, because that is not something you want coming up a couple of weeks before you're expected to file.
Yeah, we work with a gamut of clients in terms of call it financial statement readiness. Everything from companies that don't have financial statements prepared to, they've got something, they're feeling okay about it, all the way up to, hey, we've got a full set of financials prepared and we're feeling really good about it. So we work with all those types of clients. What I will say is I love bringing Joe and the technical accounting team in to these assessments where companies say, hey, we're feeling good about our financials. But we say, hey, let's kick the tires on a couple of things. We take a look at some of these technical topics, and very often there are things that come up, right, that are sort of surprises. Oh, this is a great read, something that we haven't thought about. But most importantly, sometimes there are positions that clients take on some technical topics. And my goal as part of these public company readiness assessments that we do a lot of is holistically to say, what are these potential topics that the SEC may come back and have questions on? And again, it's not to say that we're going to definitively address all these potential questions and topics that may come up. It's more so for management. Let's go in eyes wide open on this topic and make sure we have really good comfort for what may be coming. How may we address it? Do we feel comfortable with that risk appetite? and make sure that, you know, we're comfortable with the path forward. Great. We know there are risks. We're comfortable with the path forward, and let's just do the thing.
Awesome. Yeah. Thinking about that, sort of going in eyes wide open, having frankly as many inputs as possible. Would love any thoughts you might have on what collaboration with auditors ought to look like in this process. You know, how would you define that dynamic between an internal tech accounting team, folks like yourselves helping out with an engagement, and the external auditors that a company might have been using for the last several years? What does that back and forth look like? Are there certain scenarios you wish that the company got in front of with their auditor earlier that might make your engagement smoother or more efficient? How do you think about that whole relationship?
Now, the auditors are definitely one of the key parties that we work with, that we interact with. Ultimately, it's, you know, they sign off on these financials along with management, right? And we're there to make sure that they're interacting appropriately, that things are as efficient as possible, that we're really fleshing out any potential issues as a group. And, you know, I think for the most part, I mean, it's in everyone's best interest to work together. And, you know, I would say, you know, I was an auditor and it's really helpful to have a good relationship. You know, it makes the entire process more fun, right? When you're going late nights, when you're trying to get through stuff that can be really sticky. And when you're working through it together, it's, you know, it's all a group effort. So I would say what we always encourage and what clients and auditors really like is a ton of upfront communication, ongoing check-ins. And I like to do it weekly. Just, hey, if we don't need it, we don't need it. But what are you thinking? Here's what we are thinking. Here's some potential sticky points. Let's talk through those and be really kind of walking hand in hand throughout the process. And I would say the vast majority of our engagements work like that. Every once in a while, you might have a company that says, you know what, we want to get this all the way through the finish line before we even present it to the auditors. It can happen, and we've done it. And, you know, you're putting together your best story. Is there risk there? Maybe, right? Depending on if it's really judgmental, I would highly discourage that because one, you're wasting a lot of time if you're ending up somewhere different, potentially somewhere different. So, but again, I mean, it really is to everyone's best interest normally to work together in a very interactive and collaborative fashion.
Especially thinking about the process of going through an IPO and the S1 itself, there's so many different and discrete work streams that are also happening with these. You know, Joey said it well, like these are key partners that are key stakeholders throughout the process. It's not just simply getting through an audit with them, but very often it also includes getting through quarters. It maybe includes going through an AICPA to PCAOB uplift. It includes having them take a look at the whole rest of the document. There's the SAS 100 reviews. There may be also starting to look at controls and surrounding processes even more than the past. And oh, by the way, because this is so accelerated, they may be doing even more from an interim auditing perspective. So exactly right, Joe, keeping in lockstep with them, not just on some of the technical topics that come up, but just all these overlapping work streams is really powerful for improving your chances for a successful IPO and frankly for making everyone's process run much more smoothly, a lot less surprises and really good collaboration.
Yeah, and really on that, thinking about honing in on the S1 filing itself and those discrete work streams, right? We have drafting business descriptions, disclosures, risk factors, MD&A, legal. How do you effectively coordinate across the teams? How do you make sure that there's alignment there? Obviously, when there's poor coordination, poor communication, that causes delays. How do you make sure that that doesn't happen? When you think about sort of organizing a team around running the process, how do you make sure that you've got the right folks leading it with the right mentality?
I think a lot of that is making sure, and now we're going to expand our working group to the lawyers and the bankers and making sure that everyone is aligned on a timeline, on the responsibilities and what we're working towards, and making sure that you're focused enough, right? So from a finance team standpoint, there's so much that they're doing. And that's where from an S1 standpoint, I'll say, we'll come in and say, okay, this is great. let us run with it so that we give you a draft that you could start reacting to, right? Versus having everyone in there and trying to make some progress, but being scattered in different directions. So it's really being focused on, hey, let's have someone who's going to take responsibility for this section, come back, loop back for feedback, be able to react to it and move it forward, until at the point was where it gets into the document. Now you're still responsible for those sections, and then kind of having a broader review, right? But making sure that happens throughout versus okay, let's have everyone work on everything or throw everything together and just not be efficient and going through that. So, I mean, that's from the document itself. There's going to be a lot of folks that are very invested in what's in that, especially that initial document, right? The S1, because that's going to be how you lay out your story. And a lot of that will carry forward, whether it's to your future, your roadshow, discussions with investors, analysts, and then also your future filing. So everyone's got a lot invested in it, right? And just making sure that it's not so scattered, knowing that everyone also has other responsibilities.
Maybe one other quick thing too, outside of the core areas that Joe and I work with on, MD&A and F pages and whatnot, the lawyers will take care of the risk factors, but often overlooked is your business section. And very often clients who are drafting these it will be the first time that they're preparing the content in this one and potentially their first IPO too. So we're talking about some maybe marketing folks and product folks. And again, folks who aren't drafting this disclosure and maybe aren't familiar with S1s in the past. So a lot of times what I'll recommend is start at a high level. Think about whose input do we need for some of these sections. Again, non-financial and non-legal sections. Who's going to be contributing to the document? And then let's start with an outline and start building it there. Don't boil the ocean to start with. Think about who you want to be comparing yourself to from a business perspective. Of course, everyone's business is different, but who do we like how they've marketed themselves in the past? Taking a look at that, again, starting high level, and then you'll get there from a drafting perspective, but making sure that you're aligned on the structure, again, especially the business section.
Mm-hmm. Mm-hmm. Excellent. Well, one last question from my end here. I'm curious, companies often check the right boxes. They've got SOX readiness, SEC filings all in order, quarterly reporting cadences in place, but still struggle after going public. What would you say separates companies that successfully transition into public life from those that hit major roadblocks after it happens? And in some ways, just want to revisit this notion of if you were to identify one thing that finance teams should really stress test before ringing the bell. What's the blind spot?
I would say the transition to public life often brings a lot of pressures, especially to deliver short-term results. But I think it's pretty key to stay aligned on your long-term vision, making sure that you're thinking through, hey, not just this next quarter or two. I think this applies even to the finance and accounting teams as well, right? It applies to management, but it also applies to finance and accounting, whether there's an acquisition on the horizon, where there's new product rollout, whether there's a new accounting standard that's being rolled out, making sure you're thinking through those longer term needs and not just focusing on those short term scrambles.
So Joe, if you were to reflect on all we've talked on today and distill one piece of advice for pre-IPO companies, what would that be?
I would say start thinking early, getting ahead of the potential timeline. And, if your board is saying maybe 2 to 3 years, but if the right opportunity comes, it may be earlier. But really having those discussions early on, having those discussions with external service providers, such as Connor Group early on, to really be able to plan it out. It doesn't mean that you'll do everything at once. We are by no means saying, hey, you've got to get your audits done. You've got to do all that stuff if you're 4 or 5 years out and whatever, but really being thoughtful in what might make sense and so that you can react accordingly.
Awesome. Well, Joe, Jordan, we're unfortunately coming up on our time here. So where can folks go to learn a little bit more about you and your work?
Well, connorgp.com is our website. And definitely there's a lot of great information in there. But I would say the best way is, pick up the phone, have a call with Jordan or myself or one of our, we know we do have a lot of other folks, but I'm always happy to chat through and kind of understand where you're at, what you might want to consider. And yeah, picking up the phone is definitely great. Both Jordan and my information can be found on the website. And if you head there, send us an email, give us a call. I'm happy to chat.
Awesome. Tremendous. Well, thank you both.
Absolutely.
You've been listening to Incoming Statements, a production of Numeric. To learn how AI and automation are eliminating the manual burdens holding your accounting team back, visit numeric.io. Join us next time to hear from more top accounting voices on the challenges they're facing and where they see the industry heading.